Good morning, everyone. My name is Gordon Richards. I am one of the directors in our Byfields business team here in Perth. Thanks for joining us at our webinar this morning. Sorry, I think I've just dropped my screen off. Apologies. Where today we're going to be running through business and ATO debts, basically. So we've still got a few people that are joining in, but given we're just past 9 o'clock, I might get started and hopefully you can all hear me and see me okay. I'll be going through a few slides and pausing in between for questions. If you do have any questions, please feel free to use the Q&A button down at the bottom of your screen, and I'll pause as we go through each section and answer them to the best of my ability. So I'll just share my screen quickly. Okay, so hopefully you can all see that okay. So we'll start with the normal disclaimer. So it's obviously just general in nature. And if you need any advice, please get in touch with one of your accountant or one of us here at Byfields. A bit of a personal disclaimer. My wife is currently 39 and a half weeks pregnant. So if my phone rings and I get a worried look on my face, unfortunately, I might need to end the webinar pretty quickly. But hopefully that shouldn't happen. So what we're going to cover today is business solvency and insolvency. We'll touch on director penalty notices, which I think are becoming more and more prevalent. ATO debts, payment plans, and what to do if you get into a debt with the ATO, and some strategies on how you can protect yourself. I think the presentation should go for around an hour. It shouldn't be too long this time. It's fairly succinct slides, but obviously if there's questions and things, then that will take a bit longer. But it shouldn't be too much longer than an hour. So business solvency, and what is it? So basically, solvency is the ability to meet debts as and when they fall due. So it's vital in any business, as I'm sure most of you know, because if a business is not solvent, it's not going to last for too long. It's basically the degree to which current assets exceed current liabilities. And that comes down to the liquidity. So I think, I'm sure a lot of you know what liquidity is and how it works. So if a business is not liquid, i.e. its current assets don't necessarily exceed its current liabilities, then there's a question as to whether it's solvent or not. There are a number of businesses where you might not have the liquidity in it. So in other words, the current assets don't necessarily exceed the current liabilities. However, that's not always a reason for that business to be insolvent. A good example is large transport companies often have large amounts of equipment loans and things which are due within the next 12 months, i.e. current liability, and don't necessarily have the current assets to exceed those, but they keep going and they're not insolvent. So that's solvency. Insolvency is obviously the opposite. So any person or company or business who is not solvent is insolvent. And insolvency is a very important thing for any business owner, not just to maintain the life of the business, but as far as ASIC in the Corporations Act is concerned, you as a company director have a duty not to trade insolvent. And if you do trade insolvent and things go pear-shaped, then you can be held personally liable. And I think there's a number of years jail time and big fines associated with it. So as any business owner and as any director, you've got a personal duty to monitor your business's insolvency and protect against it, basically, and ensure that you don't trade whilst you're insolvent. A couple of the warning signs that we often see for businesses that have solvency issues. So one of the first ones that tend to sort of go astray is unpaid ATO debts, so GST and PAYG. Unfortunately or fortunately, whichever way you look at it, the ATO is generally the first person or first group that doesn't get paid. Because, as I'm sure most of you can appreciate, if you don't pay the ATO, yes, it's not good, but they don't necessarily come knocking straight away. Whereas if you don't pay a supplier, then they will stop your supply and you stop business very quickly. Okay, so unpaid GST, PAYG, and employee super are generally the first things that don't get paid. Rounded payments to suppliers. So if you, as an example, if you've got a supplier that issues an invoice for $6,000 and the business pays $500 here, $300 there, $1,000 there, that generally indicates that they don't have the ability to pay those debts in full and are just paying off as and when they can. And so that indicates that, there's a bit of a warning sign there. A lot of that obviously then leads to that third dot point, which is when the supplier has had enough and ceases supply, which may then lead into the fourth point, where business will go around credit shopping. So if one supplier ceases, then they might go to a different supplier, try set up credit with them and just see how they go and use that one for a while until that one stops and then goes to the next one. And that can be the case with credit cards as well. They max out one credit card and apply for a different one, max out that one, and so on. So that's a primary indication of a business that is struggling and needs some help and needs some attention. Overdraft is exceeded or at its limit. So again, just for a business that is struggling financially, it's always going to be in its overdraft, always going to be at the top of that overdraft. And won't have the cash flow to clear that. Increased difficulty in collecting debtors. So where a business is struggling financially, it's often due to that point. So its debtors aren't paying when they're due, and therefore that liquidity doesn't turn over and it doesn't get the cash in to pay off its short-term debts, basically, which is obviously that second last point, which is poor cash flow. And then that last point, just on checks, checks are becoming a bit of a past issue at the moment. Obviously, some people still use them, but that's less common. It used to be a case where a business might issue you a check to pay off an invoice, and that check would bounce, and that's a primary indication that business is struggling financially and its solvency is lacking. There's a few defenses, I suppose you would call them, to insolvency. It's important to distinguish between this and the next slide, which is a safe harbor. A defense is, look, it's not, if push comes to shove, it's not necessarily, if you turn to the courts or to ASIC and say, well, I was taking reasonable steps to incur the debt, or to avoid incurring the debt. So it's not going to protect you necessarily, but these are just things that you can look at doing that might help you get through the insolvency period. Okay, so if you expect that you are insolvent, or you suspect rather that you're insolvent, and you're having difficulty in paying your debts, the fact that you take all reasonable steps to incur or to avoid incurring additional debt is a defense somewhat, basically. Okay. Relying on information from another person, so that is within reason. It's not going to be a sole defense if you rely on info from a third party or from an employee saying that you're solvent. As a director of a company, you've still got to do your due diligence to make sure that your business is solvent. So blaming it on someone else isn't always going to, get you across the line. Okay. Preparing realistic and accurate cash flow forecasts. That's basically, just again doing your due diligence, making sure you're trying to remain solvent and trying to get through this tough time, basically. And those last 2 points are again trying to sort of trade through it, I suppose. Seeking third-party funding. So if you continue running the business whilst you're trying to get third-party funding, it is a part defense, because you're coming up with a plan to get through it. Entering into payment plans with the ATO and the suppliers and the likes, basically. Okay, so I think the biggest issue with this is identifying that you've got an issue, or the business has got an issue, and taking action accordingly. Okay, and that might mean that the action might mean that it's any one of those 5 steps, okay, or a combination of them. There is a safe harbor. So ASIC have documented a safe harbor where if you are basically, and this is directly from them, that directors are somewhat protected from insolvent trading, where they've developed a course of action that is reasonably likely to lead to a better outcome for the company, and they must incur the debt in connection with that course of action. So that comes down to what I mentioned before in terms of taking action. So realize that you've got a problem, try and come up with a course of action or figure out a plan as to how you're going to get out of that, and take reasonable steps in incurring additional debt to get out of your insolvent trading, basically, to overcome that issue. And that's it's important distinction between doing that and actually having a plan around it, as opposed to, I need some more stock, I'm just going to incur a debt with this supplier to sell off some stock, or to keep that debtor happy, and it's a bit mishmash and no real plan behind it. Okay. And whilst you're doing that, you need to keep your ongoing obligations. So you can't go and say, right, I've got a plan and I'm going to incur this additional debt to get out of my insolvent trading, and to get out of this hole that I'm in, but then go and ignore all your other creditors and your other payment ones and that, because that, it doesn't tick this box in terms of the safe harbor, basically. Okay. So as I mentioned, insolvency is a big issue, and there's a big risk with it, because if you do trade insolvent and you're found guilty of insolvent trading, there is some pretty hefty fines and or jail time as well. So it's got to go down a fair way to get to that point, but it's just, most of the businesses that we tend to see and that we tend to help that are almost beyond help, it's because they just didn't recognize the problem and took it too long. Okay, so be proactive, identify that you've got an issue, and put your hand up for some help early. I did have in my notes to break for a few questions and answer for some questions, but I don't think anyone's popped anything into the Q&A box. And if you do have anything that you want to raise, please feel free to pop them in that questions and answers box. The next one we'll cover is director penalty notices. Excuse me. So, look, director penalty notices have been around for a long time. They have always been an issue. but I feel that they are going to become more and more of an issue, and are going to become more and more prevalent. So I'll touch on it a bit later, but we're finding the ATO in post-COVID days are being a lot harder to deal with and a lot more ruthless. And so we haven't quite seen them yet, but I feel that more and more director penalty notices are coming. So what a director penalty notice is if you've got a business that's operating through a company or a trust with a corporate trustee, ASIC can basically issue a DPN, which is a demand for the company's debt that has been issued to the individual director. Okay, so it's where the director is being held personally liable for a company's debt. Okay, so we obviously always think of the corporate veil with companies where whatever debt is within that company, it's the company's issue, and you are protected. You as a personal shareholder or director are protected against the company's liabilities. This is one of the very few circumstances where that corporate veil is lifted and you don't have any protection, or you've got very minimal protection against that. Okay, so if you've got a company that has outstanding GST, outstanding PAYG withholding, superannuation, any of those sorts of debts, and haven't paid it for very long, and basically stuck your head in the sand, the ATO can issue a director penalty notice and you would be held personally liable for that debt. Okay. So there are two types of DPNs. Okay, the first one is called a non-lockdown DPN, and the second is a lockdown DPN. Effectively, you want it to be a non-lockdown DPN. Okay, and the distinction between the two is effectively what course of action you can take to get out of them. Okay, so if the ATO issues a lockdown DPN, you've got a problem. The only way that you can extinguish a lockdown DPN, so in other words, get that DPN off of your name, is to pay the debt in full. Okay, there's no other way around it. So unless you go bankrupt, so bankruptcy and or pay the debt in full. So you've got a pretty big issue if you get a lockdown DPN. On the other hand, a non-lockdown DPN, you've got four options. Pay it, okay. You go into administration, which is where you appoint a registered administrator to manage your business and manage the company to clear off debts and come up with a deed of company arrangement or the likes to clear creditors. A small business restructure, which is I'll touch on a bit later. It's a new form of debt mitigation that administrators are using and can use and works pretty well, or wind up your company. Okay, so yeah, there's a few different avenues for non-lockdown DPNs. So you want to make sure that it's a non-lockdown DPN as opposed to a lockdown DPN. With the reason or the distinguishing factor between the two in terms of how you can avoid a lockdown is based on your lodgements. Okay, so timing is vital. So effectively, if your lodgements, so your BAS lodgements, your PAYG withholding monthly lodgements, and your superannuation payments are more than 3 months late, it's automatically a lockdown DPN. Okay, so that 3-month period is vital. So if we're coming up to, or we've just passed the December due date for lodgement, so for your December BAS, your due date was the 28th of February. So if it's 20th of March, April, May, if you lodge after the 28th of May, you basically are risking a lockdown DPN. Okay. So a lot of the time clients tend to think, well, I'll just stick my head in the sand. I won't lodge these BASs. And that way the ATO doesn't know that I've got a debt and they won't come and chase me. Yes, but you're risking you're risking a lockdown DPN. Okay, so rather lodge your BASs and negotiate with the ATO to enter into a payment plan or to defer payment or things like that. Okay, so don't stick your head in the sand with lodgements. You need to keep your lodgements up to date. Okay. The one tricky thing with that is regarding superannuation. Okay, so superannuation, as I'm sure we all know, is due within 28 days after the end of at least the quarter. You can pay it more regularly than that, but it's at least a quarterly thing. Super is deemed to be lodged when you pay it. Okay, so, but obviously if you don't have the cash flow, then you can't pay it. Okay, so what happens there is where you can't pay super or where super is paid late, you need to lodge a super guaranteed charge form, which is a form that you lodge with the ATO saying, this is my super for the quarter, I can't pay it, it's going to be late, this is what it is. They then raise the debt on the system, and you need to pay that to the ATO, whether it's on a payment plan or otherwise. The ATO then collect that super and distribute it to the employee super funds. Okay, so again, you can't, it's a difficult one where if you can't pay it, then how is it deemed to be lodged? You technically need to lodge one of these SGC forms, super guaranteed charge forms. Okay. The second part in terms of timing is the 21 days to act. Okay, so this is where you've basically got 21 days from the date that you get that you are issued with a DPN, in order to avoid it becoming a lockdown DPN. Okay, so say you get all your lodgements up to date, and everything's all good, but then the ATO issue you with a non-lockdown DPN. Then if you ignore that and it's 21 days after the date that DPN has been issued, it converts into a lockdown DPN. Okay, and the only way to get away with that is to pay it. Okay. So yeah, timing is vital. Keep your lodgements up to date. As I said at the bottom there, recognize the problem and be proactive. Just don't stick your head in the sand and leave it too late. And I've just seen Ian's raised a question on solvency. I think when a business is treated as insolvent, is a business wound up straight away and enter a liquidation process, or is the business going to be considered as salvageable? So I suppose what happens there, Ian, is if you, as a company director, identify that you've got a solvency issue, you can either go back and rely on the safe harbor and come up with a course of action to try and trade out of it. You've just got to be very careful. Otherwise, you would speak with a liquidator or probably an administrator first, because they might come up with a bit of a plan to get you out of that. Okay, and as I said, could be administration, where they come up with a plan to pay out X cents in the dollar for your creditors, or they might automatically say, look, you've got no chance, we'll just liquidate. Or they look at the small business restructure, which I'll touch on a bit later. Okay, so it doesn't necessarily mean that if you are experiencing some cash flow issues and got a suspicion regarding your solvency, you don't need to shut the doors and liquidate immediately. You can put a plan in place to get through it. So going back to DPNs, so just, yeah, as I said, timing, keep your lodgements up to date, don't stick your head in the sand. So what to do if you receive one. contact us, basically. Just get in touch with your accountant straight away. Don't ignore the mail. Basically, DPNs are sent out. It's on this next slide here, but they are sent out to a director's home address as listed with ASIC. Okay, so it comes as a paper form in the mail. We have had circumstances where the ATO actually give it to us first, but that's them doing a favor as opposed to anything else, basically. Okay, so they do come in the mail. As we know, Australia Post can be a little bit unreliable at times, so just bear that in mind, because it's often, up to a week after you receive that, or after that letter is issued, that you actually receive it. Okay, and by this stage, you've potentially received a whole bunch of debt notices in the mail, and therefore anything with an ATO logo on it, you're probably ignoring by that stage. Don't do that, because going back to those timing issues, if it takes 7 days to arrive, you've only got 14 days left to deal with it, which is not very long. Okay. Get all your lodgements up to date and keep them up to date. As I said, lodgements are vital, and they, because once they are past that 3-month due date, they are, you're done, and it's a lockdown DPN. Okay. And just negotiate with the ATO. Like, the ATO are, they're often reasonable. I'll be honest, they're probably being less and less reasonable at the moment, but they often are reasonable, particularly if you get someone decent on the other end of the phone. And so they'll do what they can to help you. And we've got some tricks and that to deal with them, and how we negotiate with them. So just, don't be ignorant about it all. Don't stick your head in the sand, and actually contact them and negotiate with them. So a couple of other things to note on director penalty notices. So as I've mentioned, they are sent to a director's home address as listed with ASIC. So just make sure that you check your mail at home. And also a vital thing with that is make sure that your address that ASIC have on file is up to date. Because if it gets sent to an old address and then there's mail forwarding that comes through, quite often you'll get that letter and you've got a day or two to act, if that. Because it's taken Australia Post 20 days to get it. So don't ignore your mail. And make sure that ASIC have the correct file address on file. Okay. So director penalty notices can be issued to trusts with corporate trustees. So from an asset protection thing, we often have a corporate trustee that is controlling a trust. So if you're a director of that corporate trustee, it can be issued to you. And they can apply to past directors as long as they were in office when the liability was incurred. So, if you're a semi-silent director that you've just been along for the ride, for lack of a better word, in the company, and then you realize that there's a debt and you resign, it's not going to extinguish your risk. You're still going to have a risk there of that director penalty notice applying or being issued to you. Okay. Similarly, for new directors, they can be issued to you as long as you've been in office for at least 30 days. So even if the debt was there prior to you being appointed as a director, as soon as you've been in there for 30 days, the ATO can chase you. Okay, so do your due diligence before signing on as a director, because if there's debt there, then you just inviting risk, basically. So just make sure you do your due diligence, you make sure that there's no debt in the company, or there's a plan to pay it off prior to you coming on board or something like that. Okay. And the ATO can also issue a DPN if a company has been deregistered. So if it's been deregistered and the ATO figure out that there's a debt there, they can come and chase you personally for that debt. The only other one that I don't have on there is basically the ATO can, there's a specific word for it which I've just gone blank on it, but they can chase multiple directors at the same time, and the company for that matter. So I've got a good example where I've got a client that had that was operating through COVID. There were 2 directors of the company, and throughout COVID there was shutdowns and the likes, and the CFO at the time somehow decided that he wasn't going to pay any ATO debt. So he said, he didn't pay any ATO debt for the entire period. So the debt racked up, and the overdue payments racked up, and also he hadn't lodged BASs. Okay, so there was a mountain of debt there that hadn't been lodged and hadn't been paid. Eventually we said, no, you need to at least lodge them and then enter into payment plan. So we got all the lodgements up to date. The ATO were being a pain to deal with and actually didn't help us at all with that debt. So they issued DPNs, some of which were lockdown DPNs and some were non-lockdown DPNs. So the company went through administration, and with that they got rid of the non-lockdown DPNs, but the lockdown DPNs are still issued to those 2 directors. So the same debt is showing as being owed by both directors, and the ATO will chase whatever they can get. Okay, so they will find the easiest source of funds and chase that person. So if one person's lives in Western Suburbs in Dalkeith or wherever it is and has lots of money, and the other one not so much, they'll obviously chase the one where they can see they've got the most possibility of getting their funds back. Okay, so they can chase 2, 3, 4, 5 people at the same time for the same debt. So that is the end of the directive penalty notice section. Don't think there's any other questions on that for the moment. So the next part we're going to talk about is how the ATO treats debt, and what you can do to sort of make your life a bit easier when it comes to the ATO. Okay, so payment plans, compliance history and how that affects your dealings with the ATO, and finally debt release. Okay, so payment plans, look, we do hundreds and hundreds of payment plans every year for clients. Since COVID, they've been the ATO have been very easy to deal with it, to get them across the line. That is changed, and it definitely has changed in the last few months, where historically we were basically able to say, look, this is what we want, and the ATO would accept it within reason, obviously. Whereas now, we need to effectively sell it to the ATO why we need this payment plan, and what's going to happen if we don't get it. So they're being very hard to deal with in terms of payment plans and interest remissions and the likes. Okay, so but they're still possible. So with your payment plans, all the lodgements must be up to date. So if you've got outstanding lodgements there, they're not going to deal with it. Okay, and it's probably in your best interest to get lodgements up to date anyway, because if, say for example, you've got a BAS that is outstanding but it's not due yet. Okay, so say again, going back to the December BAS example, December BAS is due end of Feb, early Jan or mid-Jan, you get there and you think, okay, well, I've got a debt with the ATO, I'm not going to be able to pay it. What do I do? Enter a payment plan. It makes sense to lodge that Feb BAS, even though it's not due, because otherwise, because that means that that debt is part of that plan. Okay. Whereas if it's not, and that lodgement hasn't been made, even because it's not due, you can enter your payment plan, but then that debt that's due end of Feb will have to be paid in full. Okay, so with payment plans, you have to meet the ongoing payments, and all existing or all ongoing obligations must be paid in full. Okay, so if it means lodging early, just do it and include it as part of the payment plan. Okay, because with payment plans as well, you can, that's just a minimum payment that you have to make. You can pay more than that, obviously, and extinguish that debt a lot quicker. So yeah, obviously payment amounts and frequency, whether it's weekly, monthly, fortnightly payments, you've just got to think about that. And importantly with that one, and trying to determine the payment amount, is you need to keep up with your ongoing obligations. Okay, so there's no point in saying you're going to pay X dollars to the ATO, whereas from a cash flow perspective, that's going to drain your cash flow, which means that you're not going to pay your Fed BAS or your December BAS when it's due. Okay, so make sure from a cash flow perspective that you generally pay what you can, bearing in mind you've still got your ongoing obligations to meet at the same time. In terms of that frequency, the ATO do like upfront payments. So payments within 7 days, I'm pretty sure it is. Okay, so if you turn to them and say, you know, I want to set up a payment plan, but my first payment is only in a month's time, it's going to be a lot harder to get across the line than if you say to them, I'll pay a payment now and then the second payment in a month's time. So yeah, just bear that in mind to try and have some resources available so you can make a payment up front. I'm pretty sure, I think if you turn to the ATO and say that you'll pay it by BPay or EFT, they will give you 7 days to make that first payment. Whereas if you go on a direct debit, so they just pull the funds out of your account, they'll give you a bit more. So you might get 2 weeks for that. The time taken to clear the debt, obviously the shorter the easier to get across the line. So if it's only cleared within a couple of months, it's a lot easier to negotiate with the ATO than one that's going to take a couple of years. Pretty much the longest time that the ATO are accepting at the moment is 3 years. Okay, so as soon as you try and pay your debt off over longer than 3 years, they will basically deny that payment plan. Okay, trying to negotiate 3 years will be very difficult anyway, but it is definitely possible. But yeah, anything longer than that is basically I won't say impossible, but it's very hard to get across the line. Capacity to pay. What that is the ATO, excuse me, they basically ask for a bunch of info to determine your capacity to pay that debt off. Okay, so they will ask for details of your monthly income and your monthly expenses and a breakdown of those amounts. They'll ask for your assets and liabilities and effectively a statement of position. They'll ask for whether you've looked at alternative sources of finance, whether you've got family members that can help, basically a life story. So as I mentioned, for shorter payment plans, it's not such an issue. Or for shorter payment plans that are lesser of an amount, we don't often get capacity to pay requests. But for bigger debts that are over longer periods of time, almost every time we get asked the capacity to pay. Okay, so if we provide a capacity to pay that shows you've got, 10 grand worth of excess funds per month, and you ask for a payment plan of $1,000 per month, they are unlikely to accept that plan because they recognize that you've got 10 grand worth of excess cash flow, but you're only paying one of that to them. They'll ask for, generally, I think it's between sort of 70 and 80% of that excess cash flow they'll want to go towards that payment plan. Okay. So yeah, that's becoming more, as I said, more and more prevalent, and they're becoming harder and harder to do. So as I mentioned, yeah, generally capacity to pay is only really with the longer debts and the higher amounts. I did one the other day where the debt was 18 grand and the client was paying it off over 3 months and they asked for it. So it often depends on who you're talking to at the ATO, but they are asking for it more and more and making them harder and harder to do. One of the things that make payment plans easier to do is your compliance history. So having a good compliance history makes things a lot easier when you're dealing with the ATO. Okay, so that's payment plans, general interest remissions, deferral requests, all those sorts of things. Okay, and includes lodgements and payments as well. So the ATO, I believe, have effectively almost a ranking system where if you are bad payers, you're late lodgers, and you're not a great client as far as the ATO is concerned, and your compliance history isn't great, when you ask a favor for them or from them, such as payment plans and things like that, it becomes a lot harder to do. Whereas if you are seen to be proactive and seen to be doing the right thing, and your lodgements are up to date all the time, and you pay things as that on time, it makes things a lot easier to do as well. Okay. I had another circumstance where I had 2 clients they were actually part of the same group, 2 companies, exactly the same circumstances, no difference, but one had, and we were applying for interest remissions, one had a less than ideal compliance history, whereas one had a better compliance history. We got the interest remission for the better one, and the one that didn't have such a great one, the interest remission was denied. So mirror image of each other, but that compliance history made things a lot easier to deal with. Okay. So lodgements, payments, and that last point, payment plan after payment plan. So you've got your December BAS, you enter into a payment plan for that December BAS, you get to your March BAS, you do a payment plan for that one, you get to your June one. That makes things difficult in terms of negotiating with the ATO, and soon enough they're going to deny a payment plan and then you're stuck. So just be conscious with that and do your planning, do your cash flow forecasts, and yes, if you've got one plan, great, get through that and then move on. But trying to have a plan, add to it, renegotiate, get through it, add to it, renegotiate, it makes it difficult. So debt release, I'll be honest, we don't see this a whole lot. So it's effectively where you go to the ATO with serious personal and financial hardship and just ask them to release that debt or to forgive that debt. I think I've done one in my entire career. So it's not very common, but it is possible. Okay. So who can apply? Only an individual or a deceased estate. Okay, so an executor for an estate. Excuse me. Companies, trusts, partnerships can't apply for debt release. Okay, it's only an individual or a deceased estate. In terms of the debt that can be released, it's effectively anything except GST, pay-as-you-go withholding, superannuation, excess superannuation, Division 293, which is effectively a high income earner additional tax on super. So it's an extra 15% on super contributions for anyone who earns over 250 grand, or a director penalty notice. So income tax, Medicare levy Medicare levy surcharge, all those sorts of individual taxes can be released. But GST, PAYG, super, and so on can't be. Okay. And you need to jump through a fair few hoops to be able to do it. Okay, so you need to prove that you've got serious financial hardship, where you're effectively struggling to put food on the table or pay accommodation or pay for clothing or things like that before they consider releasing that debt. Okay. So because of that, we've obviously don't have that much of it, thankfully, because it's not, we don't have that, it's not that common for us, but it is possible. So a few strategies and what you can do to protect yourself. So the biggest thing, I suppose, is just planning and making sure that you are see where you're going, you're forecasting what's going to happen to the best of your ability, and you act quickly as well. So but aside from that, structuring options. So consider the type of entity that you're using. As we know, some entities offer great asset protection, others offer no asset protection. So if you're in a business that's got a level of risk and you're incurring a bit of debt in terms of creditors and the likes, go with a company or with a trust with a corporate trustee as opposed to a sole trader or a partnership. Okay. That way, if you do get into trouble, yes, avoid GPNs, but the debt is limited to what's in that company. They're not necessarily going to chase your house unless you have a lockdown VPN, okay, or breach your director duties. Okay, so think of the type of entity, and do that early. So it makes, once a business has been operating for a while and has been trading and profitable and the likes, it makes it a lot harder to restructure into the entity that you want, as opposed to doing it from the start. Okay, who are and the number of directors. Don't have a director there just along for the ride, for the title. We've had a number of clients, where husband and wife are both on there as director, but the wife has got absolutely nothing to do with the business. Okay, and doesn't even know what's going on. Resign the wife as a director and just keep the one person as a director. Okay, so because the less risk you carry and the less ability that you've got for creditors to chase the wife, as that example, the better. Asset holding entities. So if you've got a business that has a large amount of assets, so transport company, civil works company, the likes, consider having your operating business in one entity and your plant holding business in a separate entity. And then you just you charge higher fees from one to the other, basically. Okay, there is a bit of a cost benefit analysis there, because additional compliance costs having a separate entity, and the sort of complications with ongoing invoicing and cash flow and the like. So there's very much a cost benefit analysis there, but it's definitely an option to hold your assets in a separate entity. A no-brainer is property. You definitely wouldn't buy, say you're buying a commercial property for your business, you wouldn't buy it in the same entity that's operating the business, because if something does happen, that property's up for grabs. Okay. Similarly, different business activities in different structures. So if you've got two completely separate business activities, don't put them all in the same entity. If one fails, it drags the other one down with it, as opposed to if they're in two separate structures, If that one fails, that goes down, but this one can keep going. Okay, so just separate your risk, separate your business activities into different structures. From a cash flow point of view, and this comes down to that planning piece, just ways on maximizing your cash flow or controlling your cash flow. Okay. Related party wages. So if you've got a business that is struggling financially and can't pay its debts, reassess the type of or the level of wages that you're paying to related parties. Okay, obviously we all still need to earn a living and to pay for our personal costs, but think of the level at which it is. Okay, so if they're exorbitant wages, drop that back. Okay. Loans, similarly, if you've got a shareholder or a director who's continuing to withdraw funds out of the company and create loans from the company, again, it's not only a drain on cash flow. If the ATO or any external party looks into it, they don't look favorably on that. So they'll see that there's all these directors' loans and say, well, you're just taking the money personally rather than paying your debts. They won't look great or won't look favorably on that one as well. And the last one's a bit of a strategy. So that one is where, just from a tax point of view, basically, if you've got a company where it's got franking credits embedded in the company, so in other words, you've had the company for a while, it's paid tax along the way at some point in time, but is struggling financially now, rather than paying yourself on a wage, for example, consider just paying it out as a dividend. And then it effectively achieves two things. Depending on your personal income and your personal income level, you could potentially get a refund of those franking credits. So that's the franking credits are the tax that the company's already paid at 25 or 30%. Okay, so I know you can effectively pull out, assuming you've got no other income, you can pull out dividends of around 80 to 100 grand, depending on what level of franking credits you've got, before you pay a cent of tax personally. Okay, so there's a cash flow benefit from a personal perspective, because you're receiving those dividends and you're not having to pay any tax. But also in the company as well, it's helping things, because obviously if it goes through as a wage, so say for example we've got two examples. Option A is $100,000 wage. Option B is $100,000 dividend. Okay. Once the dividend's out of the company, there's no other obligations for the company. Whereas on a wage, there's pay-as-you-go withholding. So as an employee, you're probably only paid 70 odd grand of that 100 grand salary. That 30 grand withholding tax adds to your BAS liability. So that's another obligation on the company. There's superannuation on top of that, which is moving up towards 12%. So there's all these added on costs, payroll tax, the likes. So as a wage, as an employee, you're getting less in the hand as you go, because there's withholding tax. Whereas the company's also got those additional obligations. Whereas with a dividend, your employee gets the full, or the shareholder gets the full benefit of that 100 grand, and doesn't have any, or potentially doesn't have any tax obligations with it because of those franking credits. And the company doesn't have to pay the likes of super, payroll tax, pay-as-you-go withholding, and the likes. Okay. A few other things just to note as well. So I've mentioned the small business restructure a couple of times during the presentation. So this is a new option, I suppose, that's come in since COVID. I think it was introduced, don't quote me, but early 2021, somewhere around there, where basically if you are a company, so you have to be a company or a trust with a corporate trustee, you can appoint a small business restructure or an SBR practitioner, I think it's called. And if you have less than $1 million of debt, they put forward a plan to that businesses, to that company's debtor or creditors, sorry, to effectively wipe out a lot of that debt. So I had a client that we went through the process. They had, it was very, very close. They had $990,000 worth of debt, I think it was, with the ATO. So just under $1 million worth of debt. They went through the SBR process and basically got away with, I think it was 15 cents in the dollar. So instead of owing $990,000, they owed $150,000 thereabouts. And they had that, with that balance, they went into a payment plan and had 18 months to pay that off. So they went from about to go bankrupt or about to liquidate to owing a minor portion of that debt and are able to pay it off over X amount of time and get to keep their business as well. Okay, so there's a lot of requirements. Like another requirement is you have to have all your employee obligations up to date. So if you've got outstanding super, you can't do it. Okay, so but it is very beneficial. Okay, so if you're a company that has less than $1 million worth of debt, so that debt, I believe, doesn't include bank debt. So it doesn't include bank debt or equipment finance or secured debt. It's only your creditors, ATO, that sort of thing. But it is very, very beneficial for clients that have large amounts of debts. Okay. Estate planning, just consider it where, you know, you might have, if you're looking at your beneficiaries of your estate, some might have high levels of risk in their name, others won't. So just consider where you're leaving your assets to try and minimize that asset or maximize that asset protection for that next generation as well. Okay. Doesn't mean that they don't get anything, but just how you leave it to them. You know, you might put it in a testamentary trust as opposed to leaving to that person individually. And yeah, just a bit of planning ahead makes all the difference. Where the assets are held, we've touched on that already. You know, if you're a director of a company that's got large amounts of debt or large, you know, it might not be overdue debt, but there's a level of debt there. Don't buy a property in your name, put it in your wife's name or the like. So just, or in a trust or something different. So just do a bit of planning around where your assets are held. Insurance is vital, but it's only beneficial until it doesn't pay. So, you know, when in terms of asset protection conversations that I have with clients that are starting up new businesses, and we're trying to set up a company for them or advising them to set up a company, and they say, well, insurance will cover me. Yes, it will, but it doesn't sometimes as well. So just bear that in mind. I think that's pretty much it. So hopefully that's given all of you a bit of an insight into a few of the things that we think about and that we look at. Look, the biggest thing that my recommendation would be proactive. Don't stick your head in the sand. Engage with the likes of the ATO early, and yeah, it just makes things a lot easier to deal with the ATO and a lot better. So don't stick your head in the sand. Do a bit of forward planning, and you'll get through it. So yeah, hopefully everyone got a bit out of that. Appreciate you joining us. And thanks for the comment about my new baby. I appreciate that. So. And yeah, I think our next webinar will probably, I don't think we've set a date on it, but we generally have them every 3 months. So it may be June, potentially July. But keep an eye out on, email and socials and website and the likes, and yeah, we'll be in touch. Thanks everyone. Have a good day. See ya.